Dollar Swiss long-term forecast for the week of February 13th, fxempire.com. The dollar Swiss pair continues to grind sideways as it has over the last couple of weeks in a very tight range. The pair has seen a nice rally over the last several months, as you can see here, and as a result has probably needed a rest. However, there are some fundamental reasons pushing this pair along that traders should be aware of. For starters, with this candle looking like a doji, it looks like we have a plain buy signal if we can get above the 92.50 level, which of course is the top of the range. The pair can only be bought because the selling of this pair runs counter to a central bank's floor. The Swiss National Bank has put a floor in the Euro Swiss pair, and although that's not this pair, any intervention in that pair to push the value up will, of course, affect this one as well. With that in mind, it's going to be almost impossible to sell, and it does look like there's a little bit of a floor of sorts, about 90.91 in this pair. The European economy, as it continues to head into recession, or even worse, will affect the Swiss economy. The Swiss send 80% of their exports into the EU, and as a result, that deteriorating circumstances in Europe certainly will do no favors for the Swiss economy, whilst the U.S. economy has shown improvement. So because of this, it really only makes sense to go in one direction. We like a break at the top of the candle to go long till about 95, but we do think parity will be seen before too awfully long as well. Shorting, of course, as I mentioned before, is absolutely impossible to do. And then the alternative is if things get truly bad, people run to the dollar anyways. And since they can't run to the franc for fear of intervention, this is a one-way trade. It's just a matter of getting the timing right.